Hi, I'm going to go through exercise 3-10, page 127 from your textbook. This exercise walks us through the closing process, and so we'll handle all the closing entries and we'll prepare a post-closing trial balance. I'm walking through this exercise because many of you in your reflection posts indicated some amount of confusion with regard to the closing process and the post-closing trial balance. So I'm hoping that this will help to straighten some of the confusion out. Alright, so we're going to be working with the Cruise Company adjusted trial balance for December 31st. We're being tasked with preparing the December 31st closing entries for Cruise Company, and then we have to prepare the post-closing trial balance. It's important to note that the retained earnings balance in account number 318, which is about the center of the adjusted trial balance, the balance in that account is the ending balance from the previous fiscal year. So that's important to note, and we'll see why in a minute. So first we're going to record the closing entries. The first closing entry we're going to make is closing out service revenue. Now account 404 service revenue has a credit balance. So to close out that balance, we're going to need a debit to the service revenue account. And the debit to the service revenue account will mean that we have to credit something. What we'll do is we'll credit an account called Income Summary, which is account 901. What that entry does is it moves the service revenue out of the service revenue account, so it zeroes that account out, getting it ready for the next reporting period, and moves it into Income Summary. We'll have to do the same thing for each of the expense accounts. We'll need to move depreciation expense, salaries expense, insurance expense, rent expense, and supplies expense out of the expense accounts in the general ledger, and we'll move it all into Income Summary account 901. And so that's a debit to the Income Summary account for $33,100 and the respective credits to each of the expense accounts. Remember, when the expenses were originally recorded, they were recorded as debits in the general ledger. And so we need to credit those accounts to close them out. And so everything ends up in Income Summary. We have $44,000 credit in Income Summary, and we have $33,110 in debits to Income Summary. What we'll have to do now is we will have to zero out Income Summary, because the difference between the debits and the credits is going to be the income or the loss. In this case, we had net income. And so we know that net income is going to increase retained earnings, and retained earnings, in order to increase that account, we need to credit retained earnings. So our next journal entry to close Income Summary is going to be a debit to Income Summary for the difference between the service revenue brought over and the expenses brought over, which is $10,900. And the credit goes to retained earnings for $10,900. That will create a new balance in our retained earnings account. Now to close the dividends account, we need to credit dividends, account 319 for $7,000, and then we debit retained earnings, account 318 for $7,000. Now while dividends aren't an expense, they do affect the retained earnings balance. And so we do have to move the dividends out of the general ledger and put it into retained earnings. So here is our closing entries in summary form. Our retained earnings account, on December 31st of the previous year had a credit balance of $37,600. We closed out to income summary the amount of $10,900, which increases the retained earnings balance, and then we debited the account $7,000, reducing retained earnings for the payment of dividends, and our new balance is $41,500. And so now we can create the post-closing trial balance. So our post-closing trial balance is going to include only the balance sheet accounts, because we've closed out all of the revenue and expense accounts. So we have cash of $19,000, supplies of $13,000, prepaid insurance of $3,000, equipment $24,000, the accumulated depreciation of $7,500, and common stock of $10,000. And finally, we have our new retained earnings balance of $41,500. And so our balances are $59,000 in debits and $59,000 in credits. And we have successfully closed out the books. And so what will happen is, on January 1st of the new year, the revenue accounts and the expense accounts all have zero balances, which is what we wanted. And all of that activity, including dividends, has been moved into retained earnings. So we have an updated retained earnings balance. That's the closing process. It's not really that difficult. I think if you can wrap your head around it. Remember, the accounting process, we initially record our transactions. We put them into the general journal via journal entry. We then take them from the journal and we post them into the general ledger, which is represented by the T accounts. Once we're finished, we can create a trial balance. Well, when we're finished with the year, we need to adjust the trial balance for certain types of entries. And I worked through examples of that in a previous video. The closing process closes out the revenue and the expense accounts to income summary and then to retained earnings, and moves dividends to retained earnings in order to calculate the new balance that should be in retained earnings. And when we create our post-closing trial balance, all that remains are the asset, liability, and equity accounts.